Okay, hello everyone, and welcome back to our live stream sessions. So today we are again back to Diligence Training and Research Center, where we have our summer school, and it is my honor to introduce our speakers today. So Alex, who is currently working at the Central Bank of Armenia at the Macro Directorate. Alex, please.
Or maybe there's anything that the governor would like to ask first, or should I proceed with my presentation?
Yeah, no, I'm looking forward.
Okay, fantastic.
I'm looking forward to your presentation. Just to give you a sense where we are at this point in thinking our next policy move. We have all these conflicting indicators. Certainly, inflation is coming down, although some measures of inflation remain sticky. And in any case, inflation has been above our target for the last 3 years. On the other side, we see a strength in the real economy, and would be very interested in your analysis on how the risks there balance. Is the progress in inflation that we've seen, are you projecting it to continue coming down? Or on the other hand, do you see the strength in demand halting or even reversing this progress? And therefore, I would very much like your analysis and your policy input on how we should be moving.
Thank you. Thank you very much, Governor. So here's my analysis of the US economy using the risk management analysis approach based on information from July 28th. So I'm using the FBAS Mark II risk management approach. So I will be projecting different key economic variables using the different case scenario analysis. So the suggestion of the staff is to recommend the governor to maintain the target range for the federal funds rate unchanged, meaning between 5.25 and 5.5%. And here's why it is the case. So my key points. Firstly,
you mean keep it for the remainder of the year?
No. This is for the current session, for our current decision in July, and they'll proceed further how we should develop our policy rate path. So the key points, how the US economy looks, is the recent data on inflation and employment suggests cooling down of the economy. It gives some potential for the policy rate cuts. However, the level of growth is probably still above potential, and we still have strong consumption driven by the increase in household wealth that shows us that still some inflationary pressures persist in the economy. And thirdly, we have high levels of uncertainty coming from both political and economic factors that might amplify the risk of premature policy rate cuts. Therefore, let's us move to the first variable, that is the domestic output. So on the side of the case A type of considerations, we have the scenario of expansionary demand. So if the consumption remains strong, mostly driven by the increase of wealth of households, and also the fiscal policy might continue to be expansionary, then we will face the more inflationary type of scenario. And the same approach will be the result of the situation where the political uncertainty at the domestic level, that might be also related to the elections coming into the United States this year, as well as the global tensions, so possibility of escalation of the conflict Middle East, or some possible tensions with China might cause stagflationary concerns. And if these conflicts amplify, then probably we will be facing the case X type of scenario. On the other hand, we might have the case B type of considerations. And on the side of contractionary demand, we will mostly have a story about the correction of the price in equity markets. This is quite high and obvious, and through this correction, we'll have the lowered wealth of US household, and therefore consumption might be lowered. And also, if this correction is big, or if possible bubble burst, then we might have a case Y type scenario, and then also the investment might decrease because of low investors' confidence and would require huge rate cuts. But we also have another scenario that we will closely look at, which is the expansionary supply, is the situation where the manufacturing production and also innovation or long-term investments through the government programs such as the Inflation Reduction Act or other type of programs will actually enlarge the capacity of the economy and will grow output without high inflation. So let's look at the economic data. And first, what we can see is on the top graph is the GDP now by Atlanta Fed in the first and second quarter of 2024. So according to the official data, the growth was quite strong. It was 1.4% in the first quarter, but according to the nowcast 2 points from our colleagues from Atlanta Fed, it was 2.8% in the second quarter, which on the surface might raise some concerns about output that might be above potential. For example, we can see that from the end of 2023, we observed a positive output gap according to the Federal Reserve of St. Louis, as you can see in the graph on the bottom right corner. And we also need to take a look at the rising equity prices, the S&P 500 index, as well as other indices or real estates that track equity prices, as well as the real estate prices, show a significant increase since the beginning of the pandemic that might raise some inflationary concerns. On the other hand, if we actually look at the size of the output gap, then also the subcomponents of the Atlanta Fed, that we might actually see that consumption is lowered in the first quarter, and the business investments are driving this growth. We can actually, I would assign the bigger role here to expansionary supply and rising capacities of the US economy, rather than solely expansionary demand that's not as high as it used to be. So let's take a look at the labor market, which in the case A type of considerations, we'll see that the labor market would remain tight and wages would continue to grow, especially in the manufacturing sector, which was the wage growth was quite low in the recent quarters, but with rising productivity, the wages might also grow here, when in the case B type of scenarios, we might see in the extreme case, the decrease in investors' confidence if the uncertainty is high. However, what we also need to discuss is the possible levels of NAIRU, which are now estimated around 4 to 4.5% in the markets. However, we might discuss the possibility that NAIRU might be potentially higher as it shifted after the COVID levels, and it's in that situation we might have, if we underestimate NAIRU, we might move to the case A type of considerations where inflation will rebound and increase again, while if the opposite is the case, then we'll go to case B type of considerations. As we can see.
Although, Alex, I don't think we see this in the data yet, right? The NAIRU.
No,
the
we
NAIRU
don't.
seems to be pretty close to where it was. I mean, unemployment seems to be pretty close, with inflation still coming down. So
absolutely. Therefore, I believe that the case B type of scenario is more likely, and this is supported by the data, for example, on the wage growth tracker, that the wages actually going. The wage growth is actually going down, and but at the same time, the economy is slightly cooling. So probably the NAIRU is closer to this estimate, around 4%, and it is not underestimated. However, there's still a potential if the underlying inflation turns out to be higher. When we ignore these base effects, the inflation might still go up, and in a couple of months we might have a potential to revise the Nairo estimates of a bit upwards if that will be the case of the market. However, I do not really assign a big probability to this scenario, especially since the beverage curve proves the contrary. So if we take a look at the beverage curve, this data very close, the black curve, but the ones that are very shifted to the left are the recent data that might suggest that Nairo actually is back, and that the beverage curve should shifted inward, and that will show that then the level of Nairo is lower than expected, therefore suggesting more type of case B scenario considerations, which might be more likely. And here's my projection of the unemployment rate. So since in the absence of big shocks to the unemployment, we can see that both case A's and case B are quite similar, and they both converge to what is more or less expected by the market, and truly dependent on this wage growth, especially in the lower income sector, whether we'll observe the inflation as a result of the growth of wages or not. However, most probably the job market will slightly cool down. And finally, the inflation considerations. And we obviously, if the inflation will be more persistent, especially the sticky core inflation, then we'll need to wait with the reduction in the policy rates, while smooth disinflation will mean that the interest policy rates will also decrease quickly. And the other consideration that I have is the neutral rate of interest. So we are still unsure what the neutral rate of interest might exactly be. Obviously, we have the Fed median estimate around 2.8%, but actually markets price it a bit higher than that. Therefore, if the neutral rate is higher in the economy, then we'll need to keep the policy rate path at a higher level than it might than the Fed expected or a couple of months ago.
Yeah, could you remind me again why we pay so much attention to the sticky core inflation, which is, after all, not something that's widely discussed
absolutely
among the public?
Absolutely, because this is actually, the sticky core is actually the factor that might be alarming us about not cutting the rate so quickly. So the sticky core is elevated, is around 4.2% now, driven by the increase in shelter prices and some services. And we can see it goes down, but it goes down slowly. Therefore, the disinflation process is there. However, it is not so fast as some markets might expect. Therefore, we might need to have, that might be a factor showing us that we need to have a more cautious approach to rate cuts than expected by the market. On the other hand, the core, if we just discuss the core PCE, then we will have a smooth disinflation process, and this data will show that disinflation is actually there. But the question is on the on the rate at which it happens, and therefore the Federal Reserve needs to wait when it's the appropriate time in the absence of shocks. The interest rate should be cut, and I believe that according to the data that we have now, it should be the earliest in September. So
would you be risking waiting too long? Because after all, I mean, monetary policy, as you know, has operates with a certain lag, right? We may not see an impact on inflation
yes,
for the next 4 quarters or even longer. So are we running the risk of having inflation go below, overshoot below our target if we delay? Is that a risk that you have factored in?
it is certainly the risk, and if we take a look at the projection in terms of, for example, if we believe in case A, but case B actually materializes, that we will undershoot the target. But the question is, what is more risky? Whether if we believe in case A and case B materializes, or when we believe in case B and case A materializes. So obviously the risk is there. However, as according to what I've analyzed, if the inflation will undershoot the target, this should be a temporary move, and we can easily adjust the policy rates in the future. For example, in the next interest rate decision of the Fed, and communicate it accordingly to that we are moving towards the case B type of scenario. And it should not, since we have the positive output gap, it should not affect inflation. It should not affect the economy that much. However, the opposite case, so the case when we believe in case B and case A materializes, although I believe that case B is more likely, the inflationary pressures are still there. In that situation, if the inflation begins to increase again, and Fed is in the situation that maintaining the policy rate is not possible, it's not feasible, it has to increase the interest rate. In this situation, we'll have the significant risk of harming Federal Reserve's credibility. That's already harmed through to Fed, let's say, according to the public, being behind the curve in 2021. And it might create a perception that Fed do not take care of the inflation, and long-term inflation expectations could be de-anchored, which will mean that Federal Reserve will need to increase interest rates very severely, and the real risk of recession will actually be there. And this risk is much bigger than if we just keep the policy rate unchanged for a month or two, with a possibility of revising it downwards as more data will flow to us. And here, if we are just discussing this case BA and AB and BA, here I put the BAX because I believe that any situation where we believe in case B and case A materializes will directly risk the unplausible scenario of the case X, while the opposite is not the case. The risk of possible case Y, meaning the fiscal crisis as a result of rising term premia, or the financial crisis if banks suffering capital losses, will materialize, I believe, only in the extreme scenario, if markets will start expecting the Fed actually to raise interest rates, which is unlikely in the scenario of very favorable data on inflation. However, we need to have this view also in mind in order to respond adequately when necessary, for example, in the case of any stagflationary shocks. So taking a look at the United States Federal Funds interest rate, so markets expect the policy rate to stay at the current level till September, and then slowly converge to at the end of 2026 to the levels that assumes the neutral interest rate is, so around 3.5%. But in the case of case A, when the inflation would be still elevated, or most possible political uncertainty, that the Fed should keep its interest rate unchanged until the end of the year, basically, or maybe a bit longer, depending on the size of these concerns, and then revise it downwards. However, it might still stay elevated above 4%, as the neutral interest rate might be higher than expected by the markets. And in types of case B, when, for example, the equity prices will fall, or just the data on inflation will be more favorable, and we'll see some supply side growth, that it might prompt Fed to respond by a bigger rate cut than expected by the market. And they will also stay at the lower level, around 2.8%, as the median estimate of the neutral rate by the Federal Reserve is where it is located right now. So let me just discuss the issues of communication. I have some problems with changing slides.
Let me ask you something before you get into that. Can I ask something? The neutral rate. So in your case B, your neutral rate is reached by 2026, I guess, when inflation returns to target.
Yes.
And we're at the full employment. So that's your 2.8, right? It's the latest.
Yes.
The latest estimate of the neutral rate by the Fed. Why isn't your neutral rate under scenario A by the end of the period converging to that level? Why is it higher?
Because the neutral rate will be higher, and that's in the possible case A scenario. So we do not really actually know what the neutral rate is. And if we assume, obviously Fed now assumes that it's 2.8%, while markets assume to be around 3.8%. However, if we see that underlying inflation is still high, despite the interest rates stay elevated at the current level, the monetary policy being tight, that might mean that the monetary policy is not actually as tight as it seems to be. And therefore, that might mean that the actual neutral rate is higher than expected by the markets. And therefore,
Well, I understand that there is uncertainty. We don't know what the neutral rate is, but I'm not sure I understand conceptually is why we expect a difference between scenarios in the neutral rate. We may not know where it will end up, but shouldn't they be converging at some point? Because roughly some people would think of the neutral rate as your inflation target plus potential growth of the economy, right?
Yes.
So why would these be different under scenarios at the end point? I understand, of course, actual policy rates would be different in order to get you to that steady stage.
Yes. So the point is that we do not know what the neutral rate is. But the information that we might receive on inflation, for example, might help us estimate that. So if we see that the underlying inflation is high and consumption persists, etc., that might mean that our neutral rate is higher. That means that the monetary policy is not tight enough, and therefore.
But isn't inflation back to the 2% target by end 2026 under Paul's scenario?
Yes, it is. It is back to the target, but since the neutral rate is higher, for example, if the potential growth might be revised, etc., then it will be like our new steady state will be at the inflation at 2%, and let's say the neutral interest rate at 4% or 3.5%. So the real neutral interest rate will be 1.5%. So this is the possibility that we do not know. But if underlying inflation is higher for the longer period of time, that we might realize that actually the neutral rate is higher than we estimate now, but we don't know it yet. However, the data from the inflation, from higher underlying inflation, might suggest us the higher interest rate. And therefore, in this possible case A scenario, the neutral interest rate will be, the real one will be higher in the economy at the steady state, but we do not know it yet. And the same is the case B, just the opposite direction.
Yeah. Okay, we don't have much time, so
yes, let me just go to the communication
if you could,
part. Yeah, absolutely. I think there will be
if you could quickly give me a sense how you would communicate to the
I have
markets
some problems with the
recommended
PowerPoint,
course.
unfortunately.
That's fine.
Yeah, so I would just speak like that. So if the more favorable data on inflation is coming, that might be sufficient for the policy rate to move according to the case B scenario. However, if we observe this higher underlying inflation, then the interest rate cuts should be delayed. And obviously, the central bank, the Federal Reserve, should adequately respond to the shocks. So the occurrence of case X type of shocks, political instability, that would require to keep the interest rate elevated in the long run. And I don't know what's going on. Oh, yeah, I have the conclusion. So I would say that based on the recent data, in the US economy, it suggests the higher probability of the case B type of scenario, as the labor market is slightly cooling and the growth might be motivated by most supply side expansionary factors. However, even though we have a lower probability of the case A scenario, the risk associated with this scenario materializing are particularly high, higher than the cost of the mistake of believing in case B when case A is actually real are very, very high and higher than the opposite. Therefore, the Federal Reserve staff suggests the governor to keep the policy rate unchanged in July meeting and see the data that will come over the summer and observe any potential probability of the shocks. And if the data on inflation is more favorable, then we could, the policy rate path could move closer to the case B type of considerations. Thank you very much. That's it.
Okay, thanks very much, Alex.
Great. So I guess we can have like 2 minutes for you, and 2:30 we'll welcome our next speaker.
Okay, thanks.
But I need to. Oh, now I don't know what happened with my laptop, but it's working now.
It's working.
Yeah, it is working. It is working. I couldn't exit the full screen, and I will had like just one slide in front of my computer. But it always happens in the worst moments.
Okay, just give me a couple of minutes. I'll be right back.
Sergey, are you here?
Yep.
Yeah. Okay. Good. Good. Let's just wait. Yanis will be very, very soon. So we'll start.
Thanks, Alex. You can resume.
Okay, that's amazing. So, welcome everyone once again, and I have a pleasure to introduce our mock governor Yanis Halikas, who has a 30 years experience at the International Monetary Fund. He obtained a PhD at Yale University under James Tobin, and he's the senior advisor at the Better Policy Project. So now we'll have the Sergey's presentation. But before that, our governor, do you have anything to add at this point?
Hi, Sergo. Looking forward to your analysis and your recommendations. As you know, the market has revised its inflation expectation down. It now expects us to ease in starting in September, maintain this easing and at pretty aggressively, and expects the inflation target to be reached now in over a 2-year horizon. On the other hand, we do have some indications that the real economy remains strong, and to the extent that this is demand driven, it could create some upside risks. So I'm very much interested in your assessment on the balance of these risks, and if we do decide to deviate a bit from market expectations, how should we communicate in a credible manner this decision?
Great, fantastic. So let me introduce just quickly our speaker. Sergey is a student at the Global Forecasting School, and he's a macroeconomist in the National Bank of Georgia. So please welcome. We are all ears listening to your presentation now.
Okay, thank you. It's a pleasure to be here and to be able to present my analysis. So let me directly start with the analysis. And before I just move to the actual part, let me briefly again outline that the analysis we do is in terms of this FPAS framework, and under FPAS Mark II framework, which is the risk management approach. Or in other words, the way we would like to present our analysis is to see what are the risks in the economy and how the monetary policy, what should be the monetary policy in order to manage and minimize this policy uncertainty and general uncertainty, and to be able to nudge markets towards the preferable scenario. But the analysis itself, the way we do it is around these three ingredients that we think makes the best of our analysis and makes it helps us to make it relevant for the monetary policy decisions, which are obviously where is economy now, what are the underlying forces, and finally what we need to do with the policy instruments to achieve the objectives, which in this case is to obviously anchor inflation and inflation expectations. And the way we structure our scenarios and risks, which are based on our current analysis, is that we have our case A and B scenarios, and in each case, in one case, we have the scenario where the central bank needs to be hawkish, and on the other hand, we have the case B scenario where the central bank needs to be more dovish in order to achieve its objectives. And we also consider case X and Y. We are aware of these kind of dark corner scenarios where we can have very extreme scenarios of high inflation or low inflation trap, and obviously we need to do that to avoid and consider these tail risks, which could drive economy in a very costly environment, getting out of which is itself also additionally very costly. And in order to also consider these kind of scenarios, we additionally think about our case A, B, and BA scenarios. And on the example of BA, we can say that this kind of scenario is the situation where we have case A type of developments, but the central bank believes in case B type of development and follows this kind of path. And obviously, this results in a inflation further ratcheting upwards, and in the end we could end up in case X type of world where it's extremely costly due to loss of credibility and ratcheting inflation expectations to actually anchor the economy. And so considering this kind of framework in which we are, I would like to directly jump to the analysis. It's especially interesting to do this because we had the new updates on the data, especially on the GDP growth. And in terms of the GDP growth and overall real economy, the trends that we observed and that we thought would be relevant, especially the excess demand conditions and consumption-led growth continues to persist. Even in the second quarter, the GDP growth is higher than what was expected in, for example, by the GDP now. And it amounts to 2.8%, and significant driver of this is again consumption. Now, the larger part is through the service consumption, but also the goods consumption has an important role to play in it. And this further supports our story that we were telling for already for a long time, that the consumption remains elevated and drives growth. But it's interesting to again consider what is this main driver of the consumption, because after COVID, this accumulated excess savings due to precautionary motives as well as the fiscal stimuluses and expansionary monetary policies, these savings were already depleted at the end of the 2023, like approaching this pre-pandemic level. So this saving-driven spending kind of dissipated. However, consumption remains strong. And the case for the strong consumption comes from the fact that it could be supported and is supported by the elevated and increased household wealth. And this wealth is itself fueled by the high asset prices. We saw a large increase in the asset prices since the start of the COVID, since the COVID period. And if we look at the horizon, we will see around 116% increase, for example, in S&P 500, as well as some large increases in housing prices and etc. And the high equity prices obviously drive the household wealth as well as the firms' actions. And if we look at the household assets, for example, we see also there very large increase, both in financial as well as non-financial assets, which in a sense, since the beginning of the COVID, this increase is kind of larger than the volume, for example, of US economy itself. So this very large, almost 50 trillion increase in the assets is obviously supporting the household wealth, which itself is way above the historical average of the period and still persists to be strong. For example, this household net worth as a percentage of disposable income, which is a good proxy for household wealth, also remains quite elevated. Okay, and this supports again the story that consumption is fueled by wealth, and given that we still see strong wealth, this could persist further and further fuel the GDP growth. And the risks that come from this is that the consumption expenditure are themselves inflationary, because given the increased spending, it increases demand, and the excess demand pressures obviously translate into inflationary pressures. So in that sense, it's this. There is
sorry, Sergio. So you interpret this increase in asset prices is mainly a bubbly phenomenon, or could there be a more fundamental explanation, supply side, say, explanation of the
Yes,
increase
it
in
could be
asset prices?
partly. Yes, it could be partly due to, for example, we see the very strong increase in AI, and this could boost productivity, obviously. But I would say that this could be partly from the supply side, but there is still the part which could be bubbly because this large increase around 116% is too big to be fundamentally driven, given that these technological improvements and AI development isn't, from my viewpoint, the big enough to support this large increase in asset prices. Okay, so the next, if we, well, the excess demand pressure story could continue if we look at the labor market. And the actually the outlook from the labor market is in a sense a bit uncertain, because if we look at on the one side on the tightness of the labor market, for example, the vacancy to unemployment ratio, which is a good proxy for tightness and kind of shows these imbalances between the labor demand and supply, it it normalized almost normalized to pre-pandemic level. And over themselves, the vacancies as well as the decline and unemployment increase. So um, if this trend continues further, we can see some further cooling of the labor market in terms of direction, and this could help us to motivate our case B type of scenarios where these excess demand pressures are fading away, and it supports the disinflation process. However, on the other hand, we have the opposing facts to consider in terms of wage growth. And if we look at the average hourly earnings growth in year-over-year terms, it still remains elevated around 4%, which is above what we consider to be kind of sustainable wage growth, consistent with the inflation target. So if we kind of sum up the inflation target in the long term as well as productivity growth, it's above this measure. And it's important because it poses some additional inflationary risks to the economy, because obviously wages are costs for firms, and when there is high wage growth, this uh, growth in the cost of firms need to be reflected into prices to be compensated. Okay, and actually, we can say that this is kind of an issue that we observe in the inflation. Uh, and I would like to first start with the fact that obviously the recent CPI release as well as PCE release kind of had a positive surprise in it, in a sense that it has declined more than market expected previously, and this was obviously factored in the market sentiments and expectations. Okay. However, it's important to consider the underlying inflation measures to be more sure that the inflationary pressures are kind of fading away. And in this sense, it's good to look at this sticky price inflation measure, which is kind of our flagship measure that we want to look at, given that because firms that set this prices typically infrequently, given that they cannot change or they won't change prices soon enough, they incorporate in their expectations about the future. So these measures are also a good proxy for medium and long-term inflation expectations. And if they are elevated above target, it means that this inflationary premium that could be embedded in this wage price setting behavior is still present. Okay, and that's exactly what we see if we look at these measures. In 3 months over 3 months terms, we see some persistent decline, which will obviously translate into year-over-year measures, but the fact is that it still remains elevated above target. And this supports our inflationary pressure story and the fact that inflation premium could still be there, that and therefore the Fed needs to be cautious about these inflationary risks. Okay, and
historically, Sergo, historically, isn't there always a gap between the sticky price inflation and overall inflation?
yes,
So your
obviously there is.
3.2%, I thought that it tends to be always higher, right? So your 3.2%, for example, may be translate into what? Into 2.75% inflation, overall price inflation or core
Yeah, so
inflation?
like if this 3 months over 3 months rate continues to decline persistently, then it will translate obviously to year-over-year terms, and we will see further like closing of the gap between the inflation target and sticky price inflation. And you're right that obviously it tends to be slightly higher than the actual inflation and target, but my intake is that current gap is still high than what could be like sustainable or consistent with the anchoring overall inflation towards 2% target. So I would say that if the trend continues in the future, obviously this inflation process could be supported further. But for now, this gap is high enough for us to consider it as a risk. And just to
No, I'm
kind of
mentioning this because, as of course you know, monetary policy operates with pretty long lags, right, to affect
yes.
inflation. So if in fact uh, on current rates, I mean, sticky price inflation is to continue falling, don't we risk overshooting our target, going well below 2% at some point?
Yep, I mean, given these facts that we see in terms of consumption-fueled growth and excess demand pressures, as well as the labor market tightness and wage growth, I think that that scenario could be less likely than more kind of inflationary risks. However,
Okay.
that one is also plausible, and obviously these kind of risks are reflected in our case B type of considerations. However, if we come from the least regrets principle, I think this slight overshooting of the target could be plausible because, in the end, if the inflation becomes disanchored, then obviously it's way more costly to anchor it back to the target. So, given this outlook, I think that worrying about inflationary risks should be more important, or we should be more cautious in terms of our policy.
Okay. Yeah, please go on. This is very useful.
Okay. Okay. So, and just to again kind of support this, let me dive a bit deeper into the CPI structure as well as PCE structure. And in terms of CPI, I have here like 3 months over 3 months annualized rates in terms of more broader categories, let's say. And main intake is that these surprises in the CPI that we saw, positive surprises, was mainly driven by energy commodities and energy services, which has shown some quite significant decline in 3 months over 3 months terms. However, in terms of services, less energy services, as well as, for example, food away from home, which is also a part of this sticky CPI basket, has still shown some increase in 3 months over 3 months rate. And again, this is important to consider. The same story comes from if we look at the PCE in details, and we see that the service inflation in terms of PCE still remains strong and kind of could be one of the main drivers of the overall PCE inflation. And again, main intake is that the service prices are mainly usually driven by more domestic factors. So even if the overall measures are moderating, the service inflation remaining high means that we still have this inflationary premium. Again, this kind of supports our story in terms of sticky prices, and we need to be more cautious about these inflationary risks and that are still there and pose again, in terms of overall outlook, some significant risks that we need to consider. Okay. Okay. Let me just also briefly talk about our credit conditions, which remains tight. If we look at this bank lending tightening index, which is the net percentage of banks tightening their lending standards, and this tightness, as well as the higher interest rates that we observed and that we had for past year, obviously has an effect on accessibility of the credit and loans, and how much loans and credit can households, businesses, etc. can take. And we see again the decline in its growth rates, and for some categories like commercial industrial loans, we even saw some decline for some periods. So obviously these tight credit conditions and access to finance in time will and could translate into the negative demand side factors, and kind of slow down the demand and slow down the overall growth. So this kind of could indicate towards more case B type of considerations, where this weak demand will obviously accelerate the disinflation process, and will require from the policymakers to be slightly more dovish than what market expects to again achieve their main objectives. Before I move to the scenarios and risks, also I want to emphasize the fiscal sustainability risks, and the political uncertainty risks are still there, especially given that what the CBO projections are is that the deficit will widen in the future. And obviously the interest that needs to be paid for the debt could also increase. And this is actually regardless of who wins the elections in the autumn of this year. The outlook isn't really different. Under the one case, we will have the higher debt still persisting, while in other case we can expect even the further tax cuts that could further kind of exacerbate this situation, because this is risky for the overall economy. This could have impact on the term premium, which could increase in the future. And obviously, this is another risk to consider, as it could also drive the neutral rate in the future, which we think could be higher, given also the robust performance of the economy despite the tight monetary policy. Okay, so it could be higher than what Fed's estimate is, but if these fiscal sustainability issues continue, and the expectations are that they will continue regardless of who wins the election, then this obviously will have further not only risks in terms of the higher neutral rate, but also the financial stability risks, because the banks themselves hold some securities, and if the higher interest rates also be in the future, this obviously will reduce the value of these securities that they hold, and could lead to capital losses that could exacerbate some financial stability risks. So considering this information and what we have seen in terms of updated information, the market has revised its expectations compared to beginning of the July towards the fact that they expect they are more probable. So there is more probability of the rate cut in the September, for example, it has increased. And that's not only the case, but the terminal point of the market expectations curve, which is market estimate of the neutral rate, is also around 3.5%. That means it's higher than what the Fed estimate is, which is around 2.8% right now. So even the market, given the current outlook, still expects also higher neutral rate. But the scenario in terms of market expectations is more in line with the smooth landing, where the policy rate path will approach the neutral rate in the medium term, while all the indicators will smoothly converge to equilibrium values without any significant shocks or the bumps. Okay, so given all this information, let me just summarize our case A and B scenarios. So in case A, considerations, we base it on these facts that given the strong household wealth could persist, driven and driving the consumption, this consumption will lead to, again, growth remaining robust, and as a result, we will have the demand side pressures persisting. And if we add to this the labor market, which remains tight in terms of wage growth, then overall we could have the strong demand side pressures, which will translate into inflationary pressures, obviously, and the underlying inflationary pressures will be strong. And in addition, if we consider here also the higher neutral rate risk, which comes also from fiscal sustainability, then in this case, it could be required, it will be required to have a tighter stance of the policy in order to curb and mitigate all these risks and fulfill the mandate. While in case B type of considerations, we base it on the fact that given we think stock market might be overvalued, we could see the stock market correction. These risks and the stock market correction and reduction in asset prices will obviously affect the firm's investment incentives as well as the household wealth, and in combination with the labor market, which we think in terms of direction cools down, will kind of negate these excess demand pressures, make it weaker, and will support obviously the disinflation process. Also augmented with the fact that we could have and might have tighter loan conditions there. So in this case, B type of considerations, we could very well, and we will require, central bank will require to have a more dovish stance in order to fulfill its mandate and achieve its objectives. And let me just briefly present these quantified scenarios, which again represent these narratives. And again, in case A type of considerations, we have the higher policy rate, which normalizes to higher neutral rate, because in case A, again, we expect the higher neutral rate given the considerations of the robust economic growth and as well as fiscal sustainability issues. And this fiscal sustainability issue could have long-term implications, or the term premium, which in the long run can become higher. And these two combinations obviously will drive the long-term government bond yields, which will remain elevated compared to the market expectations. And obviously the higher policy path will induce to mitigate these excess demand pressures and inflationary pressures, and could generate some slack in the future. And this is actually consistent with the least regrets principle. We might need some economic slack to anchor inflation and inflation expectations. While in case B, the story is obviously the opposite, what I've described in the narratives, where stock market correction and all these weaker demand side pressures will translate into a faster disinflation process, and and the central bank in this case will need to have a lower interest rate path, or be more dovish than what the financial market currently expects. So this was all from my side.
Just to make sure I understand, you would deviate substantially from the market, right? If you place more weight on your scenario A, is your recommendation that we should not be changing rates the rest of the year?
Yes, orally. Yes, orally, I think I'm more for me, it's more probable that case A type of risks could materialize. And in order to again avoid these BAX type of scenarios, where the central bank might follow more dovish stance and fail to anchor inflation expectations, then as a loss of credibility will incur higher costs and make it more difficult to anchor inflation expectations. I think we need to be more cautious in this case and consider this case A type of risks seriously.
Okay, thanks. I think we are out of time. Unfortunately, I have to run. I have another meeting. But thank you very much. This was quite interesting.
Thank you so much, Sergey. And I believe Annie is next. So Yanis, once you are ready, I will start introducing.
Can you see my screen? Hi, everyone.
Go ahead, please.
Yes, we can. So welcome everyone again. And I have a pleasure to introduce to you our mock governor, Ioannis Halikas, who has 30 years of experience at the International Monetary Fund. He obtained a PhD at Yale University under James Tobin, and he's also a senior advisor at the Better Policy project. So before listening to Annie's presentation, Governor, do you have anything to add at this point?
Yeah, hi, Annie. Looking forward to your assessment and policy recommendations. We are, as you know, about to make a decision on how to move next or whether to move. We have certainly we are observing some progress on inflation. However, inflation does remain above our target and has remained above our target for the last 3 years. The market is expecting us to move in September to start easing. How do you assess the risks? How do you see the evidence from the strength of the real economy? Is this a strong demand pressure that should lead us to deviate from market expectations or not?
Thank you very much, Governor, for your remarks. Let me introduce our speaker, Annie. Annie is a level 1 student at the Global Forecasting School, and as well as Annie is a macroeconomist at the Central Bank of Armenia. So welcome. The floor is yours.
Thank you for the questions, and I'm so excited to provide the future probable scenarios with my perspective. And so this approach of providing future scenarios comes from this newly established FPAS system that Central Bank of Armenia has been utilizing since the beginning of this year. And the previous FPAS system only was focused on the baseline scenario, which has its own drawbacks, and especially in terms of uncertainties, as we see recently. So there is a COVID pandemic. After COVID pandemic has hit economies as well, the recent geopolitical tensions, uncertainty kind of became inherent, and you cannot eliminate it. But you can provide your own perspective of different risks coming from the different angles of the economy, and you can by weighting these risks, you can do these least policy regrets policy of risk least regrets. And so problem of having only one scenario, baseline scenario, is that it might give a false assurance of public and financial markets of future probable events happening. And also it might restrict, and they may not consider other risks, other significant risks. And it also might restrict policymakers in their communications and in their decision making. So here we do this, we think of monetary policy as risk management system, which kind of addresses prominent risks in the economy, and it considers scenarios. Those are case A, case B scenarios, also market reference scenario, which is the kind of benchmark, and it incorporates market expectations. So case A reflects an economic and financial developments, which requires higher interest rate path than what is priced in the financial market. And contrary to that, case B requires lower interest rate path. We also have case X and case Y scenarios, which address the dark corners of the economy, requiring more hawkish or dovish policy actions. So in terms of constructing the scenarios, we take into account these three questions. We address these two questions. Where is the economy now? This refers to analyzing the current stance of the economy. What we think might be driving it. This refers to the acknowledging the main transmission channels and features of the economy. And the third one, which relates to the third principle of monetary policy, according to which central bank needs to adjust its interest instruments sufficiently aggressively to anchor inflation and inflationary expectations. And if central bank fails to do such policy, then it will lose its credibility, and it will be more costly in terms of sacrifice ratio, and communication will be will become worse when they are doing their policy and trying to achieve their objectives. So this refers to these non-FPA central banks, which lack these three ingredients, and also they lack accountability in terms of transparency. So these lack of ingredients usually lead to policy actions related to elevated economics. So they can kind of present data, descriptive data without underlying story, or they might ignore the interconnection between variables and so on. They also might lack the independence, and usually this lack of independence is described by the so-called interest rate corridor. So this is a defined range of interest rate within central bank is kind of restricted to do its monetary policy, and on the upper lower bound it is restricted by the fiscal dominance, and on the effective lower bound I can bring an example, real life example of such as the pandemic events. So in case of pandemic events, we have seen that many central banks worldwide, including Fed, face the effective lower bound. So they reduce the interest rate nearly close to zero, and to stimulate the economy. And unable to reduce it even further, they turned to shift to alternative policy measures such as quantitative easing, buying government bonds, and so on. So in terms of the US case, if you look at the data, we can see that it was carried out with fiscal expansion. So as Milton Friedman has famously described it, it's like throwing money out of helicopters. And if we look at the national debt, as of June 2024, it stands more than $34 trillion, and it's a huge increase if we compare to the same period of the last year. More than $3 trillion it has increased. And together with this growing debt, we can see M2 dynamic is also increasing, which contains cash and deposits. So this reflects in precautionary savings amid both fiscal expansion and also monetary easing during this pandemic. And this influx of saving into the financial markets, this influx has drove up the prices of asset prices up, and both financial and non-financial assets the prices have increased. So looking at the S&P data, we can see it almost has doubled, and non-financial prices like housing prices have increased more than 50% compared to pre-pandemic levels. So these strengthened the household balance sheet, and it results in an increase to around $45 trillion between the first quarter of 2020 and the last quarter of 2023, and it's more than double the GDP of US, so it's a massive amount. And if you look at the decomposition, we can see that most of this increase comes from the financial asset side. So here we can see some fiscal sustainability issues. So we might assume that it will result in higher term premium.
So Annie, sorry to interrupt. So can you elaborate a bit how do you interpret this asset price increase?
So
is it bubbly? Is it fundamental driven?
So basically, this can be a mix of both of them. Both in terms of the supply side, we can see the AI productivity has increased a little as recently as we see, and this can really be driven by this fundamental increase. But also we can see there is a huge speculation going on, and with this we can say that most of this comes from the bubble side. So here we can remember this famous quote by Alan Greenspan about irrational exuberance. and it refers to the reversing of the asset prices. And in these terms, we can say that this might create some room for case B type scenarios, because if we, for example, if we assume a situation, if real interest rate remains below the economy's growth rate, it might create some additional incentives for households to borrow excessively, and because their collateral has increased massively. And when this bubble bursts, and when these prices reverse, then we will see that excessive leverage can make economy vulnerable to shocks, and this sudden downturn in asset prices, they can lead to financial instabilities, and they incorporate these deflationary risks in the economy. So this might emerge, create a room for case B type scenarios. In the worst case, we can assume financial crisis, of course. But also there are, on the other hand, there is another perspective. There is a controversy about the neutral rate being higher than what we think it is. So Fed think it is around 2.8%, and market thinks that it is around 3.5% higher than Fed's estimate. And there are economists like Larry Summers who claims that this neutral rate might actually be higher than what financial markets and Fed think, Fed perceives it to be, because we have seen the extended period of tightening, and it was not sufficient enough to tame these inflationary pressures. And here we still can see that consumption is still growing and labor market is still tight. So if I continue to consumption, to talk about consumption and domestic demand, here we see that this strong balance sheet still stimulates, motivates households in terms of huge increase in consumption, as I said, and it results in pent-up demand. And as of the latest estimate from the Atlanta Fed for the third quarter, it has increased from 2.6% to 2.8%, and services consumption is the main driving component of it. So it incorporates case A type scenario, and the strong demand, where we see that strong demand still persists, and it is fueled mainly by services consumption. Next, I want to question this increase of the consumption further. So there is a significant uncertainty related to whether this surge in consumption will persist or not. So, and this has two. I have divided this to two parts, because on the one hand, we can see asset prices are growing, but they are very vulnerable to political things, because recently we have seen a little decreasing in asset prices when, for example, Biden has announced that he will continue this competition with China, and asset prices decreased a little. But after Biden has announced that he will quit this political race, we saw that asset prices have begun increasing again. So overall, as for now, we can see that asset prices are still elevated, but there is an uncertainty for the future. We cannot say if it will grow further or not. And if so, it will go further. Will it still fuel the consumption or not? Because on the other hand, this is the second part that I want to relate, is the excess savings part. So IMF World Economic Outlook for the April 2024 has suggested that these excess savings that have been accumulated during pandemic have mostly been depleted, and so there will be no room for the consumption to fuel further. And this raises some concern. This raises some questions about will this pent-up demand continue to be like that? So this uncertainty.
Sorry, but if, as you mentioned, it's there is this possibility that asset prices are going to keep going up and household wealth is going to keep going up. Wouldn't you have a persistent decrease in saving? I mean, if households believe that they are now much more wealthy, even, I mean, they will consume a bigger, a larger share of their income, and their saving rate will be down as a almost steady state new lower saving rate, right? This could keep fueling consumption.
That's what we are currently observing. I mean, if you look at the per-pandemic norm, we can see this personal saving rate has decreased even further than this pre-pandemic norm, and it suggests that if we have used all these savings, right, to consume after the pandemic or post-pandemic events, then this is the thing that IMF suggests, that we have already used up all the savings. So this might, in the future, this might create a scenario where we have no longer excess saving to fuel consumption further. So this is the case that I want to say.
But I mean, what they've done is they oversaved in a precautionary way during the pandemic, and now they can use these accumulating savings to consume, and therefore their saving rate went down. I mean, I think that's roughly what the amounts there are. But on top of that, if they expect that their wealth will remain elevated, right, they can start consuming out of their wealth.
Yes, but on the wealth side, there is also uncertainty. That's the first thing that I said, the first part, where asset prices might they are vulnerable to political things, political turmoils, and also, as I said, some of this increase of the asset prices might be due to the bubble. So this might refer to this Alan Greenspan's irrational exuberance. So we might expect that there will be sudden downturn in the asset prices. So this creates some caution in terms of these consumption side. So this creates some caution that households might borrow excessively, but then after a sudden downturn of their assets, they might not be unable to pay their debt. So this creates some fiscal vulnerabilities, fiscal instabilities, and in the worst case, it might result to fiscal crisis. Financial crisis. So that's the thing that I wanted to highlight here, the uncertainty about both household wealth in terms of the asset prices, and also the thing that excess savings have already been almost been depleted. So this creates room for case B type scenarios. And if I continue, this uncertainty also continues in labor market also. And as there are some cooling signs, as we can see from this decrease in the job vacancy rate, still we can see this labor market continues to be overheated. And if you look at the if you look at these average hourly earnings, they incorporate these cooling signs, and we can see that recently they are on their decreasing path. But also there are some uncertainties because these wage decreases, but is still higher than what it needs to be for the sustainable growth, which should be around 3.8%, the nominal GDP growth rate. And if you compare it to consumer price index, it's still way higher. So this incorporates this average hourly earnings, the growth rate incorporates these market expectations in them. So we can say that still we see some cooling signs in the labor market, but still it remains robust. and also political tensions lead to this robust labor market, because if we look at the Trump's policy, we can see that Trump is resistant to immigration, and this suggests that labor market might still remain tight in terms of the decreased supply. So this uncertainty also is reflected in the growing difference between payroll and household surveys. And so looking at the bank's lending tightening, we can see that there are some tightening signs here recently, and this aims to generate credit crunch, and it eventually restricts the demand and it will cool down the economy. So this leads to case B type considerations. And we can see that both commercial and industrial loans, consumer loans, real estate loans, these type of loans are decreasing. They are on their decreasing dynamics. And so overall, if you look at the underlying inflation measures for 3 months average and 12 months, we can see that both of these measures recently are on their decreasing dynamics. But comparing to the 2% target, we can say that they are still elevated. And if we look at the flexible prices, I can say that sure, flexible prices adjust more quickly and they come back to target way earlier than these prices. And look, we have conducting policy, we have to take these underlying measures of inflation very considerably, and we have to be cautious. As for the market's expectation, I can say that market expects Fed to cut the interest rate starting from this September, as we can see from the Atlanta Fed's market probability tracker. And we have incorporated these market expectations into our market reference scenario, upon which we construct our case A and case B scenarios. So market expects Fed to cut the interest rate, but I want Fed to suggest that to be cautious in cutting their interest rates because of this high underlying, still elevated underlying inflation. And I want to also present and recap my case A and case B type considerations. So in terms of case A type considerations, I see higher neutral rate, so suggested by Larry Summers, and also market market also incorporates some of these insight into its expectations as well. So they think that their neutral rate might be higher than what they think it is. And it might create some additional inflationary risks in the economy. And then there is another thing that which is the consumption fueled the demand, which comes from the strong household balance sheets. We think that it still might persist in the future as well. And there is tight labor market going on, which is actually uncertain, and there needs to be we need to have some time to really think, really see the ongoing dynamics in the labor market. And speaking of the uncertainty, we can say that there are some recent signs in labor market cooling. So this refers to the case B type considerations. And under the case B type considerations, and I also have incorporated these saving rates that are coming back to their normal levels, pre-pandemic levels suggested by the IMF World Economic Outlook. And also there are some tightening happening in the loan conditions, as I said, which might generate credit crunch, and it will break the persistent demand that's going on right now. So here I want to present these illustrative scenarios. So in the market reference, in case of Fed funds rate, as I said, I incorporated these market expectations. They expect this soft landing to come, and eventually we can see that both unemployment rate comes from converges to its sustainable long-run level, and also inflation, both in terms of year-on-year core PCE inflation and 3 months over 3 months core sticky price PCE inflation, they come back to the 2% target. But in terms of KSA type considerations, I have illustrated them in a way that we have unemployment rate way lower than what we expect, what markets expect it to be, and this is lower than the euro level, and this really can illustrate the fact that labor market remains still tight and overheated, and this creates additional inflationary pressures in the economy, resulting in which will require higher policy path, as we see from the Fed funds rate. And so in this case, we can see that prices still remain elevated, and it requires way more hawkish stance from the Fed's perspective, and Fed needs to keep the interest rate in higher levels for more than we think than markets think it should do. And in case of case B type scenarios, we can see that unemployment rate is not that low as markets think it is, and there should come time that unemployment rate might even be higher than the euro rate, and this really incorporates this undershooting in the inflation levels, both in year-on-year and 3 months over 3 months. We can see that in the medium term, in the short term, inflation might actually undershoot, and then eventually it grow back and converge to its 2% target. So overall, if I can say that for now, these risks, case A, case B type consideration risks might balance each other, and I want to suggest Fed to be very careful in cutting their interest rate, and so for now, I want them to suggest to keep the interest rate constant, and not to cut this debt early as market expects, and to keep constant way longer than what market expects. So they eventually Fed might.
If you think the risks are balanced, how do we convey to the markets an interest rate path that's tighter than what the market expects? Is it how do we justify this?
Because we can see that still there are some inflationary risks in terms of uncertainties, and also if we look at the inflation rates for the core inflation, this sticky prices inflation, they still remain elevated. So I prefer to do more hawkish, not hawkish, but I prefer to keep the constant interest rates constant for a while, and then after some time to follow what market expects them to do. So that's my suggestion, because I think that if they start to cut the interest rate, then this policy tightening for an extended period might go in vain. So I really think that still Fed needs to be careful, considering this tight labor market, considering the fact that still household balance sheet is very strong, and it might fuel the consumption and the pent-up demand. So I still think that Fed needs to be cautious in further cut of the interest rate. And that's my answer. So that was it. Thank you for your attention. If you have any further questions, please.
Okay, thank you, Annie. Maybe you can do it in writing, but I think we ran out of time, Alex, right?
Yes, that's right. We
And,
need to move on with another presentation. We have Lasha, I think, waiting. Lasha, are you with us? Thank you very much, Ani, once again.
Yes, I'm
Okay,
here.
that's good. So let me know, Yanis, when we can start.
Yeah, I'm ready.
Okay, sounds good. Sounds good. Perfect. Thank you very much. So
May I
welcome once
share the
again.
presentation?
You can share the presentation. Now I'll quickly introduce Yanis, and then he will have some remarks. I'll quickly introduce you, and then you'll be ready to start. So we are having today as our mock governor Yanis Halikas, who has 30 years of experience in the International Monetary Fund. He has a PhD at Yale University under James Tobin, and he is a senior advisor right now of the Better Policy Project. So before I'll introduce Lasha, our presenter. So Governor, do you have anything to add at this point?
Hi, Lasha. We're certainly looking forward to your assessment and recommendations. We are trying here to make sense of what's going on. The market is expecting us to start easing from September on and put the policy rate on a steadily downward path. It's become more optimistic about inflationary prospects. Inflation has been coming down indeed faster than we ourselves thought a few months ago. So the market expects that over a 2-year horizon, a gradual easing would be consistent with reaching the 2% inflation target. At the same time, we do see some strength in the real economy that again we did not expect. We were expecting more of a soft landing on the real side, but we see an acceleration of GDP growth. At least that's what the Atlanta Fed is now casting now for the second quarter. Will be very interested in your assessment. Is this demand driven, which could create inflationary pressures? Is this mostly supply driven, which is much more benign? So with that background, I'd very much like to hear your assessment.
Thank you. Thank you very much, Governor, for this remark. So we'll have now the presentation by Lasha, who is a student at the Global Forecasting School and macroeconomist at the National Bank of Georgia. So please welcome.
Okay, I will briefly start talking about the stance economic situation in US. So my presentation is based on and is building and shares the principles of the shares the Mark II, FMAS Mark II principles. So we are discussing the current stance and current. We are making overview of the current economic situation. So where is the economy now, and discuss the risks that we have right now related to inflation development. And we describe the case A and case B scenarios. So to not to be reliant on the baseline scenario, we would discuss the uncertainties related to the future projections of future path of inflation, output, and etc. And we describe the we describe the case A and case B scenarios to convey the uncertainties related to those macro situation in the country. So in case A, we describe the more it's a more hawkish scenario. What if the situation what if the situation would be more inflationary than the market thinks right now, what would be the policy reaction to this development. And in the opposite case, we described the what would be the policy reaction uh, if the more if the situation, if the more deflationary shocks would realize. So we'd like to describe the and convey information both of the situation. If the development would be more like case A or more like case B, what would be the policy reaction? And we would like to convey this kind of information to the market, respective to the scenarios that market incorporates right now. But we are not it is not that the mistakes is not excluded. So there is a risk that, for example, results that case A is more realistic and B realize, and vice versa. If A realize, if we thought that things that A is likely, and we follow the case A, and B realize. In this case, we would get we would get more. This is a more we get the high inflation. We thought that it means that we think that the high inflation is more likely, and why the opposite shocks realize, and vice versa. So if we in first case we have the cost because of the more tighter policy stance than required, and it's a economic cost. And in opposite situation, we would have the cost because of missing inflation. Let me briefly overview the current economic situation and a driver of the driver of the that could be incorporated in case A and case B scenarios. Right now, we're in the second quarter of this year. The GDP growth is still strong, mainly driven by the strong consumer spending, and the consumer spending is a consumption. In turn is driven by the expenditure on services, and we can. If we look at this figure, we can see that the service is a main driver of the consumption, and consumption itself is the main driver of the of GDP growth and economic activity. So on the demand side, we could say that the demand is mainly due to this growth is mainly driven by the expenditure on services, but also in the second quarter, also expenditure on durables was so strong. It means that there is a still demand side pressure on economic demand side pressure still remains. But if you look at the labor market, but so we are saying that the consumption is strong. It's moderate. Overall GDP growth was decreasing. In the first quarter, for example, it was 1.4, but it's still high in the second quarter, and as said, mainly contributed by the strong consumption. The strong consumption could be driven by the strong labor market condition, but we have that the unemployment is actually more low, but slightly increasing. In the second quarter is at 4%. But historically is actually at low level. still low at low level. And from this side, from the perspective, from the unemployment rate, if you observe the unemployment rate, we could say that labor market is steadily easing because of the because it's compared to this previous period, it's slightly increasing. As for the wage development, also wage continues to grow. Wage growth continues to decline. In the last month, it was 3.8%, but it's still higher than the historical average of the, for example, pre-pandemic average of the wage growth. So we have that unemployment is bit increasing, wages declining. On the if we look at the labor market situation, we could say that based on this labor market development, we could say that labor market is steadily easing, and there could be less risk to further. That's from this side, the consumption would be further boosted or contributed. To follow to continue so this the following could be another argument of the why the labor market wages and labor market development uh, would not be so risky for consumption and inflation. Here we are comparing the real wage growth index and real GDP growth. We could say that it's obvious. So as we see, the real wage growth index is a lag behind the real GDP, so it's significantly lower than GDP. So after accounting the inflation, the real wage is significantly lower than the real GDP. It means that the productivity gain probably is not so fully compensated yet in wages. There is a two cases. Either we have on the one side it means that the this on the one hand it means that wage doesn't create pressure on
wage developments do not seem to be adding to inflation.
Yeah. I mean, yes, right. Or there could be also, I think also that it could be case that this there could be some tendency for catching up to the productivity gain, and if it's true, then we should expect that there could be that wage growth will continue to grow in the future. So if because it's real wage is significantly lower than the real GDP growth. Um, I said that we have the picture is that we have from the labor market the pressure on consumption, and the consumption doesn't seem so strong. And if it's the case, there should be another explanation why the consumption is strong. And the explanation could be this strong consumption could be explained with asset prices, and could be explained in the consumption could be driven by wealth effect, as we observe the household net worth, as well as the if you look at the asset prices, they are increasing. There is no indication that the asset price moderates or is on the moderation path. So it means that the strong consumption could be driven by the assets price, and those assets could be overpriced at the moment, and that could be driver of the strong consumption right now. Okay, and so we could say that inflation continues against this development. Inflation continues moderation. It seems that we have last meal until beating the until defeating the inflation, but this last mile could be most difficult because most difficult uh, if our policy reaction would be not appropriate and start to ease monetary policy. Because the sticky price inflation remains still high, and also it indicates that this last mail is not so close. We still have the maybe we are not on the last meal to defeat inflation. We have quite a long way to defeat inflation. That's why we need to keep relatively tight monetary policy stance if we look at the development. Um, if we look at this sticky price inflation more closely, this is related to service price inflation. It's related to service sectors. For example, serviceless energy inflation is quite high. So food away from home, it's also service, some kind of service, which is the inflation on those sectors is quite high, and so mainly the inflation is, as said, driven by the service sector, and we could say that this service is more domestic, so it's more sectors that's part of the domestic that's which so which mainly driven by the domestic demand, and we could because of this high inflation, because of the relatively high inflation in service sector, we could use this as an indicator that the domestic demand remains strong. As for the financial conditions, seems that the financial conditions moderates on the supply as well as from the supply side. We have we have indications that banks has tightened financial conditions bit, and also the credit and loans are decreasing, the growth, I mean. Also, I will consider some uncertainties that are related to the. I will discuss some uncertainties related to the future of the natural interest rate. No, there is a quite it's active debate about the equilibrium interest rate, natural interest rate, real interest rate. So there is some arguments that natural interest rate would be stabilized at low level in the future, but also there is arguments why it could not be stabilized at low level and it could be high in the future. The argument is that if you look at the government deficits, it's quite widened in the recent period. Actually, it has decreasing trends. On the deficits, the blue one is on the right side of this axis is widening over time, and it drives the higher public to debt to GDP ratios, which could create sovereign risks and contributes to higher natural interest rates than previously perceived. Also there is a risk that those development is quite interlinked to the current political uncertainties in US because if the Republicans will want this win in this election, then the policy could be more the fiscal policy could become more there's the expectations that deficit will widen further because because of promise about tax cuts, it obviously drives larger deficit and the risks remains in this regard, in this direction, related to the natural related to the public deficit and its consequence. It would have consequence about debt and natural interest rate development. Also, this election uncertainty. We could discuss this uncertainty related to elections, related to trade and current account deficit. The current account deficit is has moderated relative to the pandemic period, but it's still larger than pre-pandemic average, for instance. But also political uncertainty could have some implication in this regard as well. If Republicans want this win, will in this election also, and some tariffs would be imposed, it would have implication for current accounts deficit. Probably it would be if there would be if they make some restrictions in this regard, probably the current account deficit will improve. But if we consider these China's goods as a cheaper goods, it would has implication because this supply of cheap products would decrease. So there is a tendency in the recent past that the import index from China, or the goods exported from China becomes cheaper in the last period, in the last couple of years, because of the difficulties in China's economies. They are making their goods more cheaper to increase to boost their export possibility. So China's could become cheaper. It's a cheap import for other countries, US included. And if there would be some tariffs, it means that there could be some inflationary pressure because of decreasing share of cheap China's imported goods in US market on US market.
Tariffs themselves would be inflationary.
Yeah. Yes, include on top of that. Yes. Given those development in the economy markets, we expect that moderation of the moderation of the policy stance, which is tight at this moment. But market perceived interest rate in long term is higher than the Fed considers. So it means that markets thinks that the Fed follows the soft landing condition. I would like to mention that the compared to the beginning of the July, the situation market the interest rates that market considers has shifted down. It indicates that market expects that larger cuts uh, in, um, uh, in the coming period, and this is mainly driven by the more favorable situation related to the inflation. So to summarize the current situation in US, we could summarize shows that creates the case A type scenarios and shows it's good and creates a case B type scenarios. In case A considers the more stronger demand, and this strong demand will persist, even so this strong consumption continues to be high, and mainly driven by with household wealth. And also, despite that, we have not so strong indications that the consumption spending is driven by the high wages, which is also continues to moderate. Also, this if the so it's still high, and there could be some pressure on the inflation from this side, from the strong labor market. And also there is the uncertainties, the political uncertainties related to the budget deficit, and also related to trade. Both of them could contribute to, on the one hand, the larger deficit could contribute to a higher neutral rate, and also the uncertainty related to trade could contribute to the high inflation from the because of high tariffs and the low and the decrease and the smaller amount of goods imported from China, which is more cheaper. As for the case piece development, if the stock market is overvalued at this moment, there could be stabilization and returning back to fundamentals in the coming future. Or and the labor market continues to cooling down or could continue to stabilize, which would be, and then consumption would moderate if we will see developments from this side on the or this type of development on the labor market and related to assets market. So based on this information, right now we have moderation on the labor market, and also we have some indication that labor market does not contribute so strongly to the consumption, because the real wages is quite stable and non-increasing. Non-increasing, and but also we have the we have the we have as we observe the consumption situation. Consumption still continues to be high, and mainly concentrated on services. And it indicates the strong demand condition in domestic economy. Taking into those facts, and also the also the risks that are related to the natural rate and natural rate. I think that I recommend to keep the policy rate unchanged, in the next few months and in this upcoming monetary policy decision round. And so I would like to add that we are on the last mile to defeat inflation, but as some measures of inflation, for instance, some indicators of inflation, for instance, the sticky price inflation suggests that this last mile is not so close, and it still requires effort to adequate policy reaction to defeat inflation, because the sticky price inflation, which characterize which is more which is a better indicator of the demand side pressure, still remains high, and it is another indicator to keep the policy stance in the upcoming policy decision round. Thank you. If there is a questions,
Okay, thanks. I mean, there are always questions, but I think we ran out of time here. So this is the
okay.
next
Yeah.
meeting.
Thank you.
Thank you very much, Lasha.
Thank you very much, Lasha, for
Hey,
your
Alex,
comments.
can you give me 2-3 minutes? I need to
Yeah,
take a call.
absolutely. Let me know when you're back.
Yeah.
And Anahit, I think you're presenting next, right?
Yes.
Okay, fantastic. And Diana, because you're scheduled at 5:30. Is it right? Should we do it at 5:30 or can we do it earlier? Like, what do you think? How is it going to work? Because there's no one else except for you after Anahit.
It's up to you. I just thought that it's dinner time. That's why you want to start at 5:30. So you can just decide and keep me know if something works.
Okay, is it okay if we can move it to 4:30 and in this case we'll be all done by 5? Does it
Okay,
work
it's
for you?
okay for me.
I mean, if it
perfect.
works for you, okay, I will ask Yanis about that, but I think that will be easier because
It means that after Anahit, I will start. Yeah?
Yes, exactly.
Okay.
Exactly.
Okay.
Perfect.
Alex, can you see my screen?
Yes, I can.
Now also?
Yes, yes. Now I can see the full screen.
Yeah, okay.
Hi, sorry about this. I had to step out for a second.
No worries. So let me quickly introduce our mock governor today. So Yanis Alikas, he has 30 years experience at the International Monetary Fund, and he's a PhD from Yale University under James Tobin. And as well as Yanis is our senior advisor at the Better Policy Project. So before introducing our presentation from Anahit, our governor, do you have anything to add at this point?
Hi, Anahit. As we know, we are trying to reach a decision very soon about interest rates. The market has revised its inflation and interest rate expectations down. They expect us to start loosening by September in our September meeting, and then keep loosening steadily after that. They think now that given the recent progress in inflation, the 2% target is probably achievable according to their estimations uh, uh, within a 2-year horizon. There are some risks maybe on the upside given the strength of the economy and indications that demand remains strong. So in this context, I'm looking very much forward to your analysis, assessment, and a recommendation on how to communicate it to the market, given that in case we need to deviate substantially from market expectations. Looking forward to your views.
Thank you very much for your remarks. And this is just one comment, not related to the question. So we had a session with Diana planned at 5:30. This is like our last session after Anahit. Is it possible that we can just move it after Anahit's session to finish earlier?
I can do it.
Okay,
Yeah,
okay, that's good.
If Diana is fine with that.
Yeah. I talked with Diana about that. So thank you.
Perfect,
I needed to clarify. So now let me introduce our speaker, Anahit. So Anahit is a level 1 student at the Global Forecasting School, and she's a macroeconomist at the Central Bank of Armenia. So please, Anahit, welcome.
Hi, like Alexei, I am Anahit, and thank you for having me here. Today we will discuss USK under FPAS Mark II framework. This framework we adopted in Central Bank of Armenia in January, and this is a very interesting thing and useful. So as all of us know, the last years we had lots of uncertainties, and that's why the role of the monetary policy started to be more complicated because you need to adjust your policy instruments and you need to also be careful with market expectations, and also you need to assess the implications, impacts of uncertainties on your economy. So this FPAS Mark II framework is based on FPAS Mark I, and we are answering the same questions which we answer under FPAS Mark I, but this framework, like I said, addresses uncertainties, and we also are trying to incorporate non-linearities. Let me just emphasize the parts that I think that it's important to say. Under our FPAS Mark II framework, we have not baseline scenarios. We have other scenarios, case A and case B, which are constructed relative to market expectations. What is important here that when we are starting our analysis from and we are doing current analysis, we are trying to assess what risk market priced in their expectations and what risk are underpriced, or maybe there is risk that market does not see, and like based on that we are creating our case scenarios. We have mainly two scenarios, case A and case B, which the first one is when policy path is above the expectations, and the second one is when policy path is lower than market expectations. So going forward, let's see what is going on in US economy. The last update of GDP showed that we are continuing to have like a strong economy, and market expects that economy will remain strong. We can see it also in Atlanta Fed GDP now estimates, and this GDP growth, which is like higher than, for example, Fed long run GDP growth estimated by Fed. This GDP growth is mainly driven by services. We can see here that so the main driver is consumption, and in the consumption, we after COVID, we had shifts in preferences, and people started to prefer more services, like to go to cafes, restaurants, and travel. And we can see here that services contribution still remains high in personal consumption expenditures. And what is the why this services consumption is remaining this high? So because households have money for demanding more services and goods, and this money is coming from their net worth and their net worth. We can see here that household assets from 2020 increased. The increase is humongous. We can see here like $54 trillion. It's a very high amount of money. And also we can see that asset markets like starting from 2020 increased also very immensely, and this is also fueling households net wealth, and households can demand more services. And at the other hand, we have BA spread. BA spread is showing the difference between Moody's seasoned BA corporate bond yield and 10-year Treasury constant maturity bond yield, government bond yield. So like government bond is more secure, we can say like free risk in some sense, and BA corporate bond yield is the bond after which most, not most riskier, but the riskier bond that we can buy, that we can buy. I mean, after that, the bonds are more riskier, and we have more debts for buying them. And here, BA spread is the difference between them is very low, and this level is historically in very low levels. That means that businesses can for businesses to like take to finance their activity is they are indifferent between this BA corporate bond yield and government bond yield, government bonds. Sorry, yeah. Okay, so like I said, we have loose financial conditions, we have a high net wealth, and these two are increasing demand, are contributing to high to demand to remain higher, and this high demand on services is keeping economy stronger, and inflation and creates pressures on inflation. And here I wanted to also talk about term premium future trajectory. So when we are looking at this BA spread, and I'm saying that this indicates very loose financial conditions, but on the other hand, we have like a very high Fed funds rate, so the policy rate rate is very high. But why this policy rate does not affect that much financial market? So there is so this story is is about neutral rate. So because when we are talking about monetary policy, we need to we can say about their restrictiveness, how restrictive monetary policy is relative to neutral rate. And when we are looking at term premium, like last decade, term premium went down because of policy, but starting from, if I'm not mistaken, starting from a global financial crisis, there was a huge amount of debt accumulation, and there is a we can say that when these policies will normalize, this term premium can go back to its normal levels, like in great moderation times. And in that case, that means that our neutral rate is higher and policy is not restrictive enough. And these financial conditions we can also see here in households. We can see that households' debt service payments are remaining lower than pre-COVID, and if I'm not mistaken, this is historically very low levels, and that means that here we can also see that financial conditions are loose. So what does that mean? Even if we have, that we have PCE inflation and CPI inflation coming down to target, we can still see that core PCE and core sticky CPI are on very high levels. What does that mean? So these indicators of inflation are showing how how economic agents are behaving depending on their expectations. So, for example, if I am I'm doing haircut, and I know that I need to adjust my prices only each 4 months, and if my inflation expectations are high, and I think that this inflation will remain high in longer run, I will adjust my prices for keeping them competitive with market, and for not having financial how to say, for having money. Sorry for my English. Okay, so this story was about case A type of scenario, when we are saying that demand for services is high, and this is coming from loose financial conditions and households' net wealth. So here we are starting to talk about case B type of scenario, and we can see here financial conditions. So okay, let's start.
So here this tells the opposite story here, right?
Yeah.
So financial conditions are loosening, or are tightening,
yeah. And this measure, I like this measure because this is a net tightening. So if this measure is higher than 0%, that means that banks, net percent, how to say, okay. Can I just define how they are measuring this measure for explain? So we have a percentage of banks who are tightening their standards, and we have also a percentage of banks that are not tightening their standards. And this measure is okay, when why? like the difference between these two.
Yeah,
So that means that if this measure is higher than zero, that the net percentage of banks, the percentage of banks who are tightening their standards are higher than the percentage of banks who are not tightening their standards. And also this is like relative to previous in previous month. So if at this point, sorry, if here I tightened my standards and here the measure is also positive. That means that relative to the previous month, this percentage of banks tightened their standards more. Sorry for this. Yeah. And this on this side we can see that credit and loans are going down. That means that we also have tightening from this loan side. Okay, I'm not sure that yeah.
And where do you think this is coming from? Is it coming from monetary policy tightening or other factors?
I think it is coming from perceptions, and let me talk about that. So from the one side, we have fiscal policy uncertainty. So we have elections, and we have elections, and also our political politicians are talking about the trade war with China and trade war with China. Oh, sorry. Yeah, and we could see like last or previous weeks that in stock market indexes went down. This had three or four reasons. First one, it was Biden's declaration about trade war. The second one was big banks were worried about stock market corrections. They started to talk about it, and also investors started to see that their investments in AI does not show the like appropriate results. So, for example, Alphabet's Alphabet report was not like that. Good that market was expecting, and this pushed investors to like how say take their money and put in other stocks. Yeah, and okay, and also the sorry for my English. And also the policy rate in other countries also push investors to like take their money and put in other assets, in foreign assets. I mean, for example, in Canada or in EU, because in that case their present value of return will be higher, and all of this is was the result, and the result of all of this was the change in direction in stock market. And what is like important here is not the amount of is not the amount, it's about the perceptions. If all the bad things are happening in the same time, market perceptions about future will be very bad, and in that case, when market is expecting correction in stock market, they will expect that also also banks will tighten their financial conditions, because households will become more vulnerable. And I mean, for example, in we can see it in delinquency rates, and yeah, this all will create deflationary pressures and also correction. And in the worst case, this also can create a recessionary scenario, but this is also depends on Fed's policy. Okay, yeah. Sorry. Yeah, and one more thing, this is coming
strange, because historically periods of high uncertainty, right, the US is a safe haven, no? So you think this is going to reverse now?
Yeah, yeah. sorry for coming a little bit.
No, you're very clear. Don't worry. Just
let me
give.
let me talk about Ray Dalio's view. So he did a very big research, and he saw that you are when you are trying to keep your power in geopolitical world, but when you are so there is a point that you are starting to be less strong than others, and for keeping your power, you are starting to increase your defense. I mean, consumption on defense, and we can see it in.
I understand. Yeah.
Yeah, and we can see it in the US data. And also for that, you are increasing your debt for financing all of that stuff. And also you have political uncertainty, like political, say when you're, I mean, in the country, you have political uncertainty, and more aggressive politicians can come. And now, I can say in some sense I love Donald Trump, but his approach now to these elections, he is more aggressive than before, and this can cause also for I don't mean war, but you understand? Sorry.
No, that's fine. Don't worry. I can follow. So you're on balance, then you see both types of risks, both case A and case B.
Yeah.
Is pretty balanced, or do you
No,
worry more about one over the other?
So, as a policymaker, I am more afraid of case A type of scenario, because if case A, if I will choose case B type of scenario, in that case, if case A happens, I will have more inflationary pressures, and because in market we have also memory, and people, because people were in this high inflationary environment during, like, if I'm not mistaken, 3 or 4 years, they will expect that the Fed they will expect a high inflation, and they will change their prices more frequently, more aggressively. I mean, in high directions, and in that case, Fed need to be more restrictive, and I think this is more harmful for public.
Yeah.
Yep.
How do you think? I mean, if we are in fact in case A, how do you think continued restrictive monetary policy is going to transmit in the economy? Because I mean, we had tightening, right, so far,
Yeah.
and credit conditions, according to your analysis, did tighten, right? As one would expect, but consumption remained very strong. So, is there I mean, there could be risks in trying to apply high interest rates in bubbly asset markets, right?
Yeah.
We may, in fact, create the bursting of bubbles ourselves, and is that a risk that you would factor in making recommendations?
For being more restrictive without raising interest rates, I will change my communication. So I will try to be more transparent, and I think it's important to mention that I will also change my neutral rate and communicate that with public, so they will know that I will remain my rates higher, so they will expect higher policy power. And if I succeed and they will incorporate that in their expectations, in their prices, I think I will be more restrictive without increasing rates. Yep.
But
So
how do you think asset prices would respond to that tighter stance if we manage to communicate it very transparently and everybody believes it?
Asset prices, I think there is a risk to create recession, but I think it's worth it.
You still
Yeah,
you
you
would
know
still
what?
place more you would think that the cost associated with persistently high inflation, right? Your scenario PA, I think, is more costly still, right?
Yeah,
Even if you have a financial crash as a result of
actually,
pricking the bubble.
Sorry for interrupting. Actually, now I'm thinking that the probability of like how say that stock market will like that the bubble will how to say bump.
Correct.
Correct, yeah, but asset market will correct is lower. Why? Because it doesn't matter what will be the result of elections. Like during the election, I will have also inflationary pressures because this whole thing with elections, like organizing it and like this is very costly. And now when I have like strong market. This will create more inflationary pressures, and in that case, if I will not be like restrictive, so I mean there is two-sided effects. I will be restrictive, but the bubble will not, the stock market will not correct that much because I have also other side effects, like from the other side. Yeah.
Okay. Okay. Yes. Go. So yeah, if you want to give us how you would communicate this to the markets, you said you want to be transparent, which is great, but what would you emphasize so that markets uh, understand what you're trying to do?
I will. I think I will just. A minute.
Would
Like
you
yeah,
discuss those costs that you mentioned or the risks?
I will
Would you be
emphasize risks
transparent about
and
those?
I will emphasize risks because for me as a policymaker is important to manage risk in order to like have long-term stable growth, and also I will use the moment and emphasize my independency and say that look, for now when political environment is uncertain and when we have these sticky prices, I mean demand for services which is not coming down, for me as a policymaker is more important to achieve my goal in inflation targeting and unemployment. Yeah.
Okay. A true hawk, in other words.
I think that's it.
Okay, thanks very much. This was very clear to me.
And sorry for my English, I will improve it.
Fine, don't worry.
Thank you. It was really a great presentation, and certainly it was very nice to follow as well. Therefore, thank you so much, Anahit. And do we need any break, Yanni? So you can just let me know when you're ready.
Just 1 second, and we can start.
Absolutely. Let me know, and I'll introduce Diana. And finally, then we'll have dinner.
Okay.
That sounds fantastic. Perfect. Okay. You're ready, or?
Yeah, I'm ready.
Okay.
I'm ready.
Okay, great.
If Diana is ready, I'm ready.
Let me introduce for the final time today our mock governor, Yanis Halikas, who's joining us as a senior advisor at the Better Policy Project. Yanis had a 30-year experience at the International Monetary Fund, and he's obtained his PhD at Yale University under James Tobin. So thank you for being a governor today. And before introducing our last speaker, Diana, Governor, do you have any opening remarks?
Yeah, hi Diana. yeah, as you know, we're trying to figure out what an appropriate, what the next monetary policy decision would be, and also looking ahead, what would be a reasonable path for the policy rate going forward. There are a number of conflicting things, which is not unusual in monetary policy. On the inflation side, there has been progress, we must say, even though inflation remains above target for the third consecutive year, but at least there is clear clearly downward path of inflation. Markets have adjusted their inflation expectations down. They expect now that we should start easing by September, keep lowering rates, and this would enable us to achieve our 2% target within a couple of years. So it's much more benign attitude from expectations from the markets, who were previously expecting more of a hard landing ahead. On the other hand, we do have some indications coming mostly from staff's analysis on persistently, at least pockets of strong demand, which might create some risks to inflation. It's important for us to understand where this strong GDP growth, for example, is coming from. Is it demand? Is it supply? Of course, this is going to have very different, almost opposite implications on monetary policy. So we'll be very much interested in your assessment and policy recommendations at this point.
Thank you. So let me introduce briefly our last presenter today, Diana. So Diana is a level 1 student at the Global Forecasting School and also a macroeconomist at the Central Bank of Armenia. So we are looking forward to listening to your presentation, Diana. The floor is yours.
Thank you, Alexjan. Thank you, dear Governor, for this opportunity. I hope you can see my screen. Let me say that this is my pleasure to present these current economic conditions and, of course, align with FPAS-Mark II framework. I just wanted to briefly talk about why FPAS-Mark II framework. So we know that it's the main question here, why we need a FPAS-Mark II framework at the moment, because for thinking about a new framework, we need to have some mistakes or failure in ongoing ones. And of course, everything was okay with the current approaches to monetary policy. Everything worked great until we realized that the folly of baseline and local approximation can run in some storming path in some bad results. So let me briefly say that, of course, it's a good idea to have a nice projection about the upcoming developments in the economy, and of course to deal with your policy rates, understanding what it will be. But what if you are very bad in a projecting process, and what if you can even have a decision that can kill you? So that's why we started to rethink about the new framework, which is, of course, the renewed one of FPAS-Mark I framework, by thinking about how to avoid this folly of baseline and how to deal with non-linearities and avoid two dark corners. So let me just brief this example, that because the many advanced economies relied on their projections after the COVID crisis. After the COVID, they had 5 times higher inflation that it was projected in their monetary policy reports. In these graphs, you can see that the blue line is their headline inflation, and what was wrong here, that they just projected that their credibility is enough to deal with this high uncertainty, and of course they gained this higher than 10% in inflation here. So I also want to highlight the red one. So this is non-traded sticky price inflation, which we calculated in a global forecasting school with the Better Policy project. And this is more calm underlying inflation that can drive the economic conditions, and it was usually below 2% target because it highly correlated with the excess demand pressures and market expectations, and because in advanced economies the expectations were well anchored, it was usually close to 2% target. But after the COVID crisis, we had seen the increase in this red line. This is non-traded and the stickiest part of the basket. And at this moment, this measure of inflation is much higher than underlying inflation. So I want to highlight here that, of course, the excess demand conditions and market expectations are still persistently high. Even the headline inflation had decreased somehow. So that's why the FPAS Mark II framework gives us a systematic framework for incorporating monetary policy as risk management in policymaking process. So we want to understand the main risks that can drive our economic conditions to be ready to any developments, and of course to have least regrets at the end of our framework.
Can I ask you something on your previous chart?
Yeah, sure.
I'm not sure. Can you explain a bit more why we should care about the composition of inflation? I mean, for whatever reasons that have nothing to do with monetary policy, in principle, relative prices can change. I mean, relative price of traded versus non-traded good changes all the time for different reasons. Why should we pay attention to that rather than the overall price level?
So I wanted to highlight here that non-traded sticky price inflation is mainly driven by domestic side pressures. So it can be out from the external drivers such as supply side conditions or commodity prices. So that's why during high uncertainty, I think it's important to think about what is the driver of your pressures in the inflation. So it's highly correlated with the market expectations, and as I mentioned, excess demand. So if you still have these expectations that are higher than the headline that can be driven by flexible prices, I don't know, food prices, I think it's a sign that your monetary policy conditions could not be tight enough at the moment.
But if I in fact target or pay more attention to the non-traded price index, don't we risk extreme volatility in the overall price index, which is what people really follow and base their wage and pricing decisions on?
I think it's important to understand what is driver, because if it's flexible prices and if at this moment you are dealing with just change in the flexible prices, which can be some fruit prices, oil prices that can be easily checked after one month, and if you will follow this one, you can de-anchor once again your market expectations. So you will de-anchor in, and of course this panic effect and the non-linearity effect will bring you in a different space and in a bad condition, even it was before this issue. So I think it's very uncertain how the flexible prices can change.
No, I understand why you pay attention to sticky prices, but why would you? I'm wondering if the traded and non-traded distinction here is relevant.
Because the traded one is usually can be affected by the external factors, and you don't have enough sources to affect on the traded part of your basket, because it can be driven by even exchange rate or even your trading partner's economic conditions. So that's why if you want to deal with your country specific cases, the policy stance that you are relevant to impact at the moment, you need to be very careful what is the main driver or inside of your country.
Okay, please proceed.
Okay, so as I mentioned, the FPAS Mark II framework gives us opportunity not only to understand where is the economy now and what are the underlying forces, but the hardest part of this question is to understand how to deal with your policy rate to achieve your target. So now let's briefly discuss the current stance of the US economy. And as I mentioned, let's start from the inflation. So we had seen the headline, which is of course in declining path, but some underlying measures like non-traded sticky price inflation that was discussed, also core PCE and core sticky CPI are still above 2% target, which means that the persistence in inflation is still notable. So this, of course, opened the question, was enough financial and monetary policy conditions tight? Because we can easily see that, yes, senior loan officer opinion survey shows us that financial conditions are tight. But let me highlight here that, and this was a nice indicator for upcoming recession and correlation between tight financial conditions and the recession was obvious. But the last one that we had seen after COVID crisis, let me somehow present it that it was tight financial conditions, but no recession inside. And also this aligned with the double 10-year spread, which is now below the historical average. It's close to 1.5%, which means that we have extremely loose financial conditions for corporations. So we had seen communicated tight financial and monetary conditions, but we had seen some pressures in underlying inflation. And what's going on in GDP growth? Let me show you that during last quarters, GDP growth is outpacing potential. And of course, it's mainly driven by domestic absorption. I mean, thanks to services consumption, it's still hot. And of course, these also make us thinking what is the main driver of this kind of hot conditions in consumption if we had seen somehow tight financial condition. So of course it's coming from the net worth. And as I know that it was mentioned many times with me and my colleagues that it's mainly driven by financial assets, and also the household net worth is now close to 800% of this disposable income, and it's mainly driven by financial assets. And let me just show you that S&P index was doubled after the COVID crisis. We had seen more than 100% increase. And of course, it's driven by expansionary fiscal and monetary policy that pushed long-term real interest rates in negative, resulting in somehow bubbling equity prices. But let me just also mention here that non-financial assets like housing prices was driven not only by the bubble effect or something else that was seen before GFC. It was mainly driven by behavioral change. So here to think about the bubbles, I think a little bit soon, because we must see some behavioral change in households thinking to renewed our assumptions about the bubble here. So this is my short assumptions here. And of course, these hot conditions affected on the labor market because we had seen very hot labor market conditions. At first, let me say that it was driven by a hot consumption, but also the migration policy that after Trump was somehow loosened affected a little bit and drive this, let me say, labor markets supply and somehow affected on the consumption as well. So at the moment, even we had seen some cooling signs at the end of the May.
But isn't something else going on here? Because, I mean, red is the actual unemployment, right? Or these are vacancies.
The first one, the blue one is unemployment rate, which was below the Nairo. Nairo is the dashed one. And at the moment, even we had seen some cooling signs in the end of the line, I think it's still below Nairo. So I think it's still soon to think about the very cool signs in the labor market. So even job opening total non-firm also had some decline. They are upside in indices that I put it here, and maybe we can see some change in the momentum. But at this moment, I wanted to highlight that labor market is still hot, even some cooling signs at the end of the points.
Right. So
also,
yeah, okay,
yeah,
because now essentially by now vacancies and unemployment is pretty close, right? So there shouldn't be much wage pressure, real wage pressure.
Yeah,
to be expected
I didn't
from
put
this
it here.
side.
I didn't put here the wage growth. We had some cooling also in the wage growth, but still it's hot. So in 12-month growth, it's still more than 3%. So I think that it's a little bit soon to talk about the very hot, very cool labor market conditions. Of course, this is our
It's not, I mean,
for our KP type scenarios. So
you may want to re-examine this indicator because, I mean, even when in 22, for example, 22, 23, when there was a big gap between the two, right? There seemed to be a lot more unfilled positions.
Yeah, sure. And
I don't think you
yeah.
had. I don't think you had substantial pressure on real wages. So.
Yeah, sure. It can just come if the consumption will continue to be hot. It will be
right.
In the case
that might be a
better.
That might be a better.
The only case that we can see there, and the drivers for hot consumption, I think that could be the
okay.
Yeah, and also I want to talk about the fiscal dominance risk that may persist. I put here the CBO updated outlook for upcoming 10 years. So just let me show here that the primary deficit here is going to rise. So, and also net interest payments are going to be much higher than its average was. It will be about 4%, and with just sample calculation, we can easily see that R will more than GDP growth, and of course it can affect on a higher in inflation, as I mentioned, because it will affect it also, or a loss of credibility for central bank. It will affect on interest rates, and of course, even they put in their.
But what interest rates are you assuming here? Nominal interest rate.
nominal interest rates. At the moment, I think the market price is so I think it will be more than 4%, but of course below from the 5%, because if it will go higher than 5 and 6, I think it will be a case that we can.
No, because you have to compare here you have to compare, I think, right, the real interest rate with the real growth rate.
Yes, so, I think both of them are in real terms that I think that could
so
be.
You expect nominal interest rates above 6%?
I think it will be close to 5.5, something like that. It could be a case.
Okay. Yeah.
And of course, this is a case that can drive. I just wanted to say that even the expenditures part, we can see that it will go to the medical care, but also the part that can be covered by this issue is in individual income taxes. So they are going to tax more rich people, which is also some concerning distribution of income in the future. So this also can be a case that can anchor the market expectations or create some panic. I don't know. So this is a case that also could be considered in our case scenario. So yeah, let me show you also the market expectations about the market policy rates. So this is the tracker of Atlanta Fed. I just put it difference between the beginning of July, so it was the decision-making point, and at the moment it's somehow softened because the cooling signs of the labor market. But let me say that at the beginning of 2024, market expectations were mainly about 3 cuts for policy rates for this year. But at the moment, the expectations are cooling, and they anticipate 2 cuts. Just let me also here say that advanced economies like Canada and Euro area decreased their policy rates starting from May, and somehow US became more restrictive in their monetary policy conditions. But as we can see, they started Canada and Euro area, they started their loosening path, but they stopped there because they are waiting for this result for the election for both of them, for Euro area and for US as well, because it maybe somehow can change the effects. Maybe we also need to make some unchanged path for this moment after the election, but this also can be discussed in our case A and case B. So what about my scenarios? Let me say that, of course, my case A type considerations are mainly according to strong demand conditions driven by services consumption, as I mentioned. And of course, it will still keep the labor market conditions tight. And underlying inflations will keep higher. And as I mentioned, the fiscal concerns under higher real rates can affect the case A type considerations. And I put political uncertainty. I know that it can be a different story behind this result of the election. But as I can see, both results will have more case A type considerations than case B. Even that can be some differences according to migration policy or China's economies or import or export, I don't know. But as I realized, they mainly would drive the case A type considerations. And of course, the opposite one, which I mentioned, for cooling signs in labor market and the savings rate that's getting back to normal rates.
This is case B, right?
Yeah, it will be relevant for my case B type scenarios.
Okay,
of course,
so
I put for my case B also the uncertainty in the world, mainly driven by Chinese economic conditions. But also it would be affected by US policies in the future. Not only domestic factors can affect on the Chinese economic conditions. So it can affect on the commodity prices and somehow create some deflationary pressures for the US from the commodity part. So according to this, I created my case A and case B in Excel. It's not model that was derived. And of course,
sorry, you mean if commodity prices come down or go up?
Come down, because I put here the uncertainty in the word with the downward pressures from the Chinese economies, and because it's the main demand creator for oil prices and for copper prices. I don't know. It of course will affect us somehow on the decline of the commodity prices.
Yeah, but most commodity prices are not part of the Fed's target, right?
What?
Are you? I mean, oil prices, for example, are not part of the. I mean, the Fed target.
Yeah, you mean that it's not
inflation,
underlying
right?
inflation? They are out of. So I just wanted to highlight that maybe in the relative prices, because we will gain build lower oil prices. Of course, it will affect somehow on the relative prices on the other part of the basket as well. So it can even affect on the services prices.
Second round effect.
Secondary effects as well.
Okay.
So, and according to this, I have, of course, for case A, higher than market reference points interest rate. And of course, in this case, the unemployment rate will go down and will undershoot. And with, of course, higher path for inflation, and the opposite one, of course, relevant for case B. I just wanted to say that if I will recommend at this point what to do with policy rates, let me say that waiting between the anchoring of market expectations with higher inflation at this moment is more dangerous than to go to the recession, because we had seen this the anchoring and second round, this uncertainty will kill our credibility faster. So of course, I think to go to our target faster than it could be is a better solution for this point. So this is my recommendation. And if
so you should weigh more case A and be less.
Yeah,
less
I think that we need to go to the target as soon as possible, because our main goal is to keep stable prices. So we need to show market that we can deal with this mandate. And after that, we will see what is going on. And of course, we will change our policy path. It will be necessary.
Okay, although, I mean, in your scenario, even if we follow the case A policy path, we are still well above the target by in 2 years' time, right?
Yeah. Yeah.
I don't think
we need to be very careful here. It's because I didn't want to make policy rates much higher than it could be. Of course, it could be a case, but at this moment when other advanced economies starting their loosening path, and when it was communicated for a long time that we are going to cut our interest rates at June, after that at September, I think this critical rise can make some feeling that we have some fear that we can deal with our policy rates. So I'll keep it as close to our today's target as it possible. I think that the model can solve my judgments a little bit.
No, I don't think it can solve.
Yeah, it will be a little bit beautiful.
Okay, no, it's a very depressing scenario, but I mean, yeah, it could. Nothing can be excluded. So as long as you can make a good case for it, it's defensible. It's not pleasant, but it's defensible.
Thank
Okay.
you. Yeah, are there any questions, any comments from the governor, or
No,
shall
we discussed quite a bit.
That's amazing. Well, I'm sure we discussed a lot of things today, and thank you very much. Thank you, Diana, for your presentation. Thank you, Yanis, for being our governor. As just reminds me of like small things when I had exams back in high school, and after the long day of exams, everyone was happy that the exam's over, and the teacher who was supervising us was always telling us, "See you tomorrow." And it was not so pleasant anymore. So I will say the same. See you tomorrow at 8 a.m. this time. Thank you very much
for your patience. Yeah, thank you.
Thank you very much. It was
Thank
great.
you, Alex, and thanks to everybody.
Yeah.
So Yanis, we are meeting in Dax room now.
Yeah, give me 5 minutes. I need
okay.
recover.
Yeah,
I'll walk over in 5 minutes.
Oh yeah, great, fantastic. Thank you.
Okay.
See you.
See you. Bye.